I don't think everybody's going to agree with this. Welcome back to the Building Block series. We're getting into our next set of videos, which are more practical things that we're applying in our business going forward. And today we're talking about our view on equity. I don't think this will be super popular because it's a pretty conservative take on equity and value and how you should weigh those things as you're analyzing deals, whether that's on a car, a house, an investment, whatever it is. This is the general set of principles that we're using going forward. So on the equity scale, let's run it from, let's say your value starts at 0 and goes to 100. You have no equity here. That's what the asset is worth, right? We'll come down here, we'll give it a 90. So you have 10% equity between the 90 that you owe and the 100 that it's worth. That's how equity works. We'll give it an 80. We'll give it a 70, 69. For us, we're going to group everything from 69 down into the same group. A lot of people, as they buy their home, this first set of equity is going to apply to them. And I think it's something that's really important to understand when you're here, is that you're in a partnership. And it's a three-way partnership, right? If you don't have more than 10% equity in your home, you're in what I call the devil's threesome. All right, and that means that you, right here, the homeowner or the asset holder, the person who has the title but also has the debt, is in a partnership with the market, and you're also in a partnership with the bank. You can't sell this asset without the permission of the market and the bank. And a lot of times, because the bank has fees and things like that where you can't sell within a certain time frame, maybe interest rates have went up for other people, and so the bank is part of the market in that way, but we're treating it as its own thing because it can be assessed different ways. It can impact you in different scenarios. But from here to here, these are deals that you should never touch. Even as a homeowner shopping for a home, unless it's going to be your last home or you have the cash in the bank to make up the gap here. So the thing that solves all this and makes this less relevant is if you have cash in the bank, because you can just close the equity with your cash. You're looking at your net worth as a whole. If you're cash heavy, you can make that up. You can at least eliminate the bank and the market as a partner because you can bring cash to the table. However, that is not a great deal. You don't want to do that. The goal is to slowly build assets over time that you never have to bring cash to. Devil's threesome. We don't like it. All right? It's a no-go for us. We'll never own anything here unless we absolutely have to. All right, so from 80 to 90, essentially what's happening here, in my opinion, is the market and the bank are becoming more silent partners. Right now, if you're in this position here, most likely the market is your real partner. You need a strong market still if you bought here to sell here. We don't buy here either, and that's total investment. So this is a no-go zone for us too. We still look at it as a three-way partnership, even though these people are starting to become more of silent partners than anything else. From 70 to 80, this is where we start to get interested right here. This is where, even as a homeowner or as a investor, everything that you own during the first part of your career, while you're stacking your cash, while you're rebuilding, while you're building, while you're putting things together, you should start considering it probably around 75%. If you can't pay less than 75% of the value, if you gotta have it so there's function to the asset too, maybe up to 80, then you should just not even look at it, you shouldn't even consider it. And it doesn't matter how many offers you need to make on things to get into this price point, that's what you need to do. So if you need to make 200 offers to own an asset at 75%, whether that's a work truck, whether that's a house, whether that's an office building, whatever it is, materials that can be bought at a discount, that are still of the same quality, you should start there and then work your way down truly. So 70 to 80, the market's not really your partner anymore. If there's a correction in the market that says you can't sell in the 70, if you bought at 70% of value, the whole market is in trouble. In a very serious way, and most likely it will bounce back in a time period that allows you to be okay. You're gonna be in a better position than everybody else, I'll tell you that. At this point too, the bank is still a partner. They own the note. If you have prepayment penalties and things like that, you gotta at least weigh it. But like, at this point, I mean, you're not really dealing with them much. You have freedom to do what you want to do with the asset. All right, that's this. This is good. You know what I mean? This is the starting point for good investing. Don't buy anything over 75% of value, ever. From 69 down, this is where the real money is made. This is where we want to be on everything. And if we have to make 200 offers to buy a home, if I have to go on Facebook Marketplace and I have to haggle with 15 people to get a truck at 60% of value, I have to go see 10 of them. At this first part of the business, that is what you got to do. And so you're going to grow your net worth over time this way by slowly but surely stacking assets at this value. And that way, at this value, the market and the bank don't matter anymore. You know what I mean? Like, you are independent of them. You own this. You can tell both these people to go fuck off if you want to, because you have enough equity where it's a good guy on every balance sheet. And as long as you stay inside of your note and make your payments and be a responsible adult, you're always going to be okay. You're going to put more time back in your schedule too. So you can think about all of this as time too. If you're buying multiple deals up here, your time's going into rehabbing them and fixing them and paying insurance and just dealing with tenants and stuff. And so what you're doing down here is you're making more money and you're giving yourself back all of this time. And that's in the very beginning of your business, the first few years of your business, while you're getting cash heavy and making sure that everything on your balance sheet is on the right side of it. That's where you got to be, because it gives you your time back to focus on really good things. You just know that interest compounds and you're on the right side of the interest. You're compounding good assets, and over time that is something that will, it's not sexy, it's not exciting, it's incredibly boring, but it is the soundest way to build wealth. And that is what we're doing now as we rebuild our life. And that comes with everything from couches to rugs to phones. I work on the 69% principle. If I can't buy it for 69% of value, I don't want to deal with it. And I won't, and I don't have to, because I've created a life where I don't need in that way. The problem is, a lot of people are buying here and counting on their ability to make money doing something else. In here, this requires sweat equity, it requires multiple offers, it requires being patient, it requires being flexible. Here, you can go get what you want right now, but you just need to know that you're stuck in that loop, that you're stuck in the devil's threesome that is going to keep you as a consumer forever. And if you want to get to the other side of consumerism, you got to be down here, at least for the first part of your life or your business. And I wish I would have dealt with this in my 20s. Life is a lot longer than they tell you it is, and it's a lot longer than it feels when you're in your 20s. You're going to come and you're going to say, Paul, how do I buy things here? Why would anybody sell me something here, right? That's what you're thinking, and that's a reasonable way to think. Let me tell you who sells things here. People who buy here, because they are on the wrong side of the balance sheet. And eventually, they're gonna, maybe not their home or their big assets, but they will have some other asset that they have to sell in order to fund this, because they bought it wrong. And that's where you'll buy it here, because you bought everything else here, and you were patient, you were disciplined, and because you were able to buy everything here, you can buy more stuff here, because you don't have any of these. You might have a couple of these, but everything else is here, which means that you're going to have access to capital, and now the bank can be a good guy for you, and now the market can be a good guy for you, instead of being a partner that you don't want. So when you get here, this triangle like kind of inverts into a positive. Now you're in like the threesome we all want to be in, you know, where it's like everybody's having a good time. The bank loves you because you got all good guys on the balance sheet. The market, you know, is just doing its thing. It's just happy to be there, and you are just crushing it. That's where I'm starting to get really excited. Like, is this compounds over time in that way, and these people are going to have to sell to you at some point. You just got to be patient. One more thing. What will help you out with this more than anything else is understanding that you do not want to be the consumer in your life. You are not built to be a consumer. You are a laborer. All important things in life are labor. Relationships are labor. Your job is labor, obviously. Being healthy is labor. All the best things in life are labor. And if you're willing to accept that, you can buy everything here because you can put your money into it. You could buy it at 50%, put 20% more into it, and be at 69%, 70% of value. A lot of people don't want to do that here because they've become forever consumers and they're useless. All they want to do is go to work and chill. And they don't understand that has them in a cycle where they always have to make more money and make more money and make more money. And that's what's going to happen if you buy here or here. So buy here, put the sweat equity into it. That's what Flip Buddy is here to do. It's here to help the labor class participate in the upside of their own capital by using principles like this. These are raw takes on everything, and this is my raw take on equity on assets. Now, in the next couple series, we'll talk about how this compounds over time and what that looks like. And we'll talk about buying stages in the market and in your business. From mistakes that I made when I was scaling and we were doing things way out of order. And because of that, a lot of bills came due that were really inconvenient. And we probably did things in a way that could have been a lot more sustainable if we would have followed this principle from the very beginning. We should have negotiated our office rent down to 69%. We should have negotiated our commission splits. We should have negotiated every single thing instead of just counting on our ability to go make more money as the thing that would solve it. It's a hard lesson to learn, you know what I mean? But now we're here and we start here. And if you start here and you start applying that over time, you're not going to see results right away. You'll actually probably get really frustrated right away. But over time, you will figure out how to do this in a way that gives you all this time back. And you'll have less going on, it'll be more profitable, it'll be safer, and you won't have to answer to anybody else. And that's what freedom really looks like. That is the next episode of the Building Block series. Tune in next time, and we're gonna talk about scale and how to scale over time and how this compounds in a positive way for you. So, talk to y'all soon.